So you did it. You signed all the papers, you survived the move, and you finally have the keys to your new home. It's a huge moment. Congratulations. But after the initial excitement wears off, this really important question starts to creep in. And that's exactly what we're going to unpack today.
All right, let's just get right into it. You've got your monthly mortgage payment handled, but what about that little bit of extra cash you're saving? Where should that dollar go to do the most work for you? I mean, this isn't a small question. The answer could literally be worth hundreds of thousands of dollars over your lifetime. Now, before we jump into the big, heavy debates, let's talk about the low-hanging fruit. For a lot of new homeowners, there's a really obvious first target for that extra cash. It's called private mortgage insurance, or as you'll usually see it, PMI. Okay, let's zero in on that definition from the Consumer Financial Protection Bureau because this is so important. PMI protects the lender, not you. Just let that sink in for a second. You are paying a monthly premium for an insurance policy that only benefits your bank. It's a pure cost to you with zero direct benefit. So why do you even have this thing? Well, typically it's because you put down less than 20% on your home. When that happens, your loan-to-value ratio is over 80%, and lenders see that as a higher risk, so they make you pay for PMI to cover their backs. The good news, though, it doesn't have to stick around forever. So how do you ditch it? Well, there's a federal law called the Homeowners Protection Act that gives you clear rights here. Once your loan balance drops to 80% of your home's original value, you can send a written request to your lender and ask them to cancel the PMI. Even better, if you just wait a little longer until you hit 78%, they have to cancel it automatically. The big takeaway is simple. Keep an eye on your home equity and be proactive. Okay, so once PMI is out of the picture, we get to the real heart of the matter. This is the big debate, the one that happens at kitchen tables all across the country. Should you use your extra money to pay off your mortgage early, or should you be investing it for your future? Let's really break this trade-off down. On one hand, paying down your mortgage faster gives you a guaranteed, totally risk-free return. Every extra dollar you put towards the principal is a dollar you're not paying interest on. It's safe, it's predictable. On the other hand, you could invest that money in, say, your 401k. That gives you the potential for much, much higher returns over time, but it also comes with the ups and downs of the market. It's really a choice between certainty and potential. So what do most people actually do? Well, a working paper from the National Bureau of Economic Research found something pretty staggering. 38% of households are busy prepaying their mortgage before they've maxed out their tax-advantaged retirement accounts. That choice could mean they're leaving a massive amount of money on the table. Let's just look at the math to see why. Using some models from Vanguard, we can compare the two. If you're prepaying a 4% mortgage, you get a guaranteed 4% return on your money. That's not bad. It's solid. But if you invested that same money in a pretty standard 60-40 stock and bond portfolio, the potential median return is closer to 6.5% over the long haul. You can see the potential upside from investing is just significantly higher. And wait, there's another wrinkle here. Taxes. If you itemize your deductions on your tax return, you can often deduct the interest you pay on your mortgage. What this does is it actually lowers the effective interest rate you're paying. So that guaranteed return you get from prepaying your mortgage, it just got even smaller, making the case for investing even stronger. So, if it's not a simple, always do this one thing answer, how in the world are you supposed to decide? Well, the best way to think about this isn't a single answer, but a framework, a step-by-step priority list for where to put your next dollar. I love this quote from some Vanguard research because it just nails the goal. It's not just about being debt-free, and it's not just about having a huge retirement account. The real point of all this is to maximize what you can actually spend and enjoy, both today and down the road. Okay, here it is, the checklist, the roadmap for your next dollar. Step 1, and this is absolutely non-negotiable, capture your full employer 401k match. It's a 100% guaranteed return. It is literally free money. Step 2, go after any high-interest debt. Think credit cards or personal loans. Paying off a 20% interest credit card is an unbeatable return. Step 3, fund your other tax-advantaged accounts, like an HSA or a Roth IRA. After that, step 4, circle back and put even more into your 401k. And then, only then, way down at the bottom of the list, should you start to consider prepaying that low-interest mortgage. You see the logic here, right? This isn't just some random list we threw together. It's a perfectly rational sequence. It starts with the absolute highest, can't-miss, no-brainer returns, like that 401k match, and it works its way all the way down to the options with the lowest return,
like paying off a mortgage that has a 3 or 4% interest rate.
All right, let's bring all this together and talk about what this means for you and your own personal financial finish line. Because at the end of the day, this is about more than just numbers on a page.
Look, how you feel about debt, your specific life goals, how much risk you're comfortable with, all of that stuff is deeply personal, and it matters. Some people just sleep better at night knowing their house is paid off, and there is real value in that peace of mind. But what this framework does is give you a powerful, logical tool to understand the financial trade-offs you're making. Think of it as a universal starting point for your own unique journey. So as we wrap this up, I want to leave you with this question to think about. What does financial freedom actually look like to you? Is it the feeling of owning your home free and clear? Or is it having a big, robust investment portfolio that gives you flexibility and all kinds of options for the decades to come? Your answer to that question is what will truly guide where you put your next dollar.